In this week's video, we'll review the latest fundamental and technical data to help us answer the question: does Friday's labor report mean the economy and stock market are on the ropes? Referring to this chart here in the Friday, February 15th video with a trend strength score of 15, we said it was possible that the S&P 500, even under bullish outcomes, might need to consolidate some of these gains. During the session on Friday, February 15th, the S&P 500 was trading at 2767. If we fast forward to Friday's session, or March 8th, we're basically in the same spot, about 30 points lower at 2733, with a much better trend strength score of 56. As we covered previously, often a rally off the low when you have extremely low trend strength scores is followed by somewhat of a give back or period of consolidation. And then when the market was ready to move, in this case, our trend strength score is all the way up into the 80s. Similar situation here. Our trend strength score in February of this year was 15. Trend strength score was 17 at this point in 2015, and the market still had some work to do. By the time it was really about to move, the trend strength score had improved to 100. You can basically have the same commentary for this case here in 1998. When we first came up to the orange 200-day moving average, the trend strength score was 1. After some backtracking and consolidation, a much more constructive score over here. The good news in the present day is our trend strength score has improved considerably, and it's probably fair to say we're somewhat of in tweener land here, between this type of score and this score, between this score and this score, and between this score and this score. And we're still hovering around the moving average cluster, and we did give up the orange 200-day moving average this week. Since the trend strength score is scaled between 0 and 100, in simple terms and in rough terms, it's saying that 56% of the questions that we're asking about the S&P 500's trend are now coming back bullish. Thus, we have to keep an open mind about a case like this where we have a weak score, some consolidation takes place, we have a much more constructive score, and from this point here, the S&P 500 tacked on an additional 69%. With a score of 56 and hovering around the 200-day, we're not quite at a score like this or a position like this, but we still have to remain open to much better than expected outcomes. The bad news in the present day would be that we're still near the moving average cluster, and we have to keep an open mind about drawdowns occurring from here, something that we'll cover in more detail later in the video. But trend-wise, we're in a little bit better position than we were here in November of 2015. You may remember in a recent short takes post, we talked about plunge resistance. Here's a plunge here, here's a plunge here. The S&P 500 makes its way all the way back to the area of the plunge, and in this case it acts as resistance. It's possible something similar is happening in the present day. In this case, eventually resistance was cleared and really good things happened. Bad news in the present day: we had a V move off of a low, and we're still floating around the moving average cluster. We're currently below the orange 200-day moving average in the present day. The good news is our trend strength score is quite a bit more constructive than it was here. Still have mixed probabilities in the present day, but probably fair to say they're a little bit more advantageous than they were here. From this point here, which is point A, really bad things happened in the S&P 500. The uncertainty of the present situation and the present-day trend strength score, all of that is reflected in our present-day allocations. In the 1973 case, when we came back and closed above a downward sloping 200-day moving average, trend strength score was only at 33 relative to our present-day score of 56. Some additional reference points relative to some of the bearish cases that we've been looking at historically. In recent weeks, trend strength score of 28 here when we were trying to recapture a downward sloping 200-day after that bad things happened. Similar situation here in the first half of calendar year 1982 with a trend strength score of 18. The S&P 500 was rejected at the downward sloping 200-day moving average. The slope of this line and this score, the slope of this line and this score, relative to the slope of this line and this score, all of that speaks to present-day probabilities, the probability of good things happening relative to the probability of bad things happening. From this less constructive setup in 1977, which is point A, the S&P 500 lost an additional 14.46%. And from this less constructive setup in 1981, which is this point A, the S&P 500 lost an additional 14.28%. Reminding us in the present day, with price still floating around the 200-day moving average, that we need to respect a wide range of outcomes. The S&P 500 did not give up the 200-day moving average until Thursday's close, so we did distance ourselves a little bit from these cases here. Last Wednesday was the 16th consecutive trading day close above the 200-day moving average. In the simplest terms, the longer we stay below the 200-day moving average, the more concerning it would become. And the sooner we can recapture it and stay above it, the more constructive that would be. It's not unusual sometimes for the market to come down and drop below a 200-day moving average for a very short period of time and then move in the other direction. When that happens, it's typically bullish. Once again, not a forecast in the present day, just something that we'll be looking for as one possible outcome next week. 20,000 jobs created came in well below expectations. Similar situation calendar year 2016. U.S. created 38,000 jobs in May versus 162,000 expected. In this CNBC article dated June 3rd, there's one word for it, which is just shocking. A Forbes article termed it the non-farm payroll disaster. How did the market perform after the disastrous report? The gain from mid-May of 2016 to the peak in 2018 was over 40%. Similar disappointing report calendar year 2017. From mid-month to this peak here, a gain of 17%. This is the S&P 500 back in 1993. 1993 also featured a very disappointing non-farm payroll report that actually came in below the zero line. From this point here to the peak in the year 2000, the S&P 500 tacked on 238%. Another weak non-farm payroll report came to light in early 1995. From this point here to the peak, 189% gain in the S&P 500. NFP came in below zero. 1996, the gain from this point here to point B here, 155%. Another disappointing report in calendar year 1997, the gain from this point here to the peak, 70% in the S&P 500 index. Here's a look at the recent Data and non-farm payrolls. This is Friday's report. If we take a step back and show the 2016 case that we just covered, we can see that non-farm payroll data is extremely volatile. Here's the data between 1993 and 1997 that we just covered. Moral of the story: viewed in isolation, weak non-farm payroll data is not a showstopper for a bull market. In fact, it's not particularly unusual when you get an extremely strong print here over 400,000 in 1994 that sometime in the not too distant future you get a disappointing report. An extremely strong print here over 400,000. Some point in the not too distant future you get a disappointing report. Similar situation here. A print over 300,000 in the not too distant future, a disappointing report. Print over 300,000 in the not too distant future, a disappointing report. And a print over 300,000 in the not too distant future, a disappointing report. And this is Friday's report in calendar year 2019. Should Friday's week report be taken seriously? Absolutely, positively, yes. However, one report in isolation is not necessarily a trend. And as you can see here with NFP data going back to 1950, the data is extremely volatile. It's a daily chart of the S&P 500 index during Friday's session. A gap was created. The high, intraday high on February 11th, was 27.18. On the following day, February 12th, the low was 27.22, leaving a gap behind. It's possible we're in the process of revisiting that gap. During the session, as of 12:55 p.m., the intraday low was inside of the gap at the top at 27.22. In the short run, we'll learn something in this area either way. The motivation for covering the possible inverse head and shoulders pattern for SPY and the S&P 500 in a video dated January 25th of this year was really twofold. Number one, on January 25th, if we understood that this area here could act as potential resistance, it was much, much easier to take a patient and measured approach. Number two, if a pattern like this forms, and that's to be determined, it's one of many possible outcomes, and we get volatility like this over on the right side of the formation, it would align with what could still be a bullish pattern, making it much, much easier to tolerate volatility over here. It's the chart of the S&P 500, and as of March 1st, the area of potential resistance seemed to be acting as resistance. And if we fast forward to the close on Thursday, March 7th, the same thing can be said. If we have realistic expectations and reasonable expectations, it's much, much easier to manage through volatile periods. Given price action in October and November, it would not be surprising to see the S&P 500 consolidate for a while underneath this blue line. And it wouldn't be surprising to see it move above and below the 200-day moving average numerous times. There's nothing magical about the 200-day. It's simply one of many reference points. In the wildly bullish 1954 case, price comes up to the 200-day moving average, closes above it, below it, above it, below it, consolidates, rises above it, and then consolidates for several weeks above it. This left shoulder here tells us it would not be surprising in the present day, even under a bullish scenario longer term, to see the consolidation take place above and below. That is all to be determined. In the next segment of the video, we're going to update many of the studies that we've covered in recent weeks to try to gain a better understanding of what type of drawdown could we see under bullish scenarios. So last week we covered the relatively rare scenario where the 100-day moving average in blue drops below the 200-day in red. Then the market rights itself and is able to close above the 200-day for 11 consecutive trading days. And while returns were very, very favorable going forward in the historical cases, still somewhat of a mixed bag in that some of the cases failed miserably. What we want to understand from a risk management perspective, in the favorable cases, what type of drawdown could we expect in the present day relative to what happened in history? And given the rare breadth thrust and the Bollinger Band setup that we've covered in recent weeks, it's within the realm of possibility that a scenario that's very, very green going forward could be in the cards. So from our perspective, looking out a year, we're not really interested in tracking a case that's going to be down 6%, a case that's going to be down 24%, a case that's going to be down roughly 28%. Therefore, it would be helpful to know if we eliminate the unfavorable cases and focus on the favorable cases that we are very interested in. In these cases, the average return looking out 1 year was 20%, and 91% of the cases were higher a year later, with the worst case seeing only a 1% decline. Now that's something we could be interested in. So what type of drawdowns did an investor have to endure to capture these gains? And here's the answer to that. This is the maximum drawdown looking out 60 days all the way out to 360 days. And that's the maximum drawdown from the date of the 11th consecutive trading day close above the 200-day moving average, which was this study here that we covered last week. So let's focus in on the worst case. The 11th consecutive close occurred on June 22nd, 1988. And the maximum drawdown looking out 1 year from this date here was 6.78%. From a risk-reward perspective, taking a drawdown of roughly 7% would have put us on this track here. 1 year out, 16%. 540 days out, 27%. Roughly 2 years out, 33%. And 3 years pushing 40%. So if really good things are going to happen in the future, it wouldn't be particularly abnormal looking out 1 year to get an average drawdown of roughly 2.5%, a median drawdown of 1.5%, and in the worst case, it was 6.78%. And since we know where the S&P 500 was when we experienced the 11th consecutive trading day close above the 200-day moving average, we can calculate what that drawdown hypothetically would look like in the present day. And it's this orange line right here. It says the S&P 500 could backtrack to 2603 hypothetically, which seems to align with this area of congestion here, and somewhat aligns with the inverse head and shoulders theory as well. Same situation in the breadth thrust cases. The drawdowns can help us try to differentiate between the favorable cases in this table and the unfavorable cases. For example, do we really want to put capital in harm's way full bore and withstand volatility and drawdowns to capture a 3.92% return 1 year from today? That type of return profile doesn't warrant a full exposure to equities. It's just not a good risk-reward proposition. So if we remove the less desirable cases and focus on the desirable cases, because that's the track we want to stay on, what type of drawdowns were experienced in the more favorable cases. Since we're thinking risk-reward here, if we remove these cases, the average gain looking out 18 months was roughly 28%. The median gain was 30%. Best case scenario was a 62% gain. And the worst case was a 7% gain. Similar and attractive figures looking out 2 years. So for an investor in these historical cases to capture these very satisfying returns, what type of drawdowns historically did they have to endure? On average, extremely muted. The maximum drawdown from the study date was roughly 2%, the median drawdown roughly 2%, and the worst case scenario was 1962 with a maximum drawdown over the first 12 months of 8.17%. And if we look at the 1962 case, if you withstood that 8% drawdown, eventually it paid off handsomely. 730 days out, the gain was 45%. So in this study, the similar point in the present day occurred on February 12th of this year, when the S&P 500 was trading at 2745. An 8% maximum drawdown, that's the worst case scenario out of these 20 cases, would take the S&P 500 hypothetically to 2520. So on a present day chart, this is the worst case scenario here in red, and this is the average and median cases here shown in black. It would be very, very easy to withstand the average and median drawdown here. This one's a little bit more difficult and requires some planning from a risk management perspective. Another case that we've covered in recent weeks. Historically, when the S&P 500 is dropped between 15 and 30%, and then it rises back above its 200-day moving average for 9 consecutive trading days, in 2018 and 2019 fit this profile. The returns, looking out 2 years, very, very satisfying. What type of drawdown did you have to endure to capture these returns historically? Once again, average and median cases very, very muted from the 9th consecutive trading day close above the 200-day. Roughly 1% on average. The median was less than 1%, and worst case scenario was a drawdown of 5.3% that occurred in the 1978 example. The 9th consecutive close above the 200-day in 2019 occurred on February 25th with a close of 27.96. If we had a 5.3% or worst case drawdown from that level, it would take us to 2648 hypothetically, which is the pink line on the screen. And that also meshes up very, very well with a drawdown that could occur with a right shoulder, hypothetically. Can't emphasize enough, we are not forecasting anything here. We're trying to understand a wide range of outcomes and trying to understand what drawdowns look like in favorable cases. Why? Because it can help us leave our investments alone and try to stay invested in order to capture what could be satisfying gains. Conversely, if the drawdown starts to exceed what we saw historically in the favorable cases, it starts to tell us we may be trending toward one of the unfavorable cases. Thus, the drawdowns help us discern between the favorable volatility to ignore and leave it alone cases and the unfavorable volatility to respect cases. Ultimately, this analysis helps us with our circuit breaker stop loss levels. Similar situation. Last few weeks, we've covered the Bollinger Band setup. It's described in this February 19th short takes post with this title. And just to jog your memory, here's some visuals of that rare setup. Not really excited about being fully invested to capture a 5% loss over the next year. It's not a very good risk-reward proposition to be fully invested in equities to nail down a 2% gain over the next year. So we're not really interested in tracking these cases, but if we eliminate those two cases, the performance after similar setups in the past, looking out 1 year, was outstanding in some cases and very, very consistent in the others. So once again, to capture this type of return, what type of drawdown was involved over this 1 year period historically? Once again, in the average and median case, fairly muted. The average drawdown from the signal date, which in 2019 would be the end of January, the average drawdown was 3.28%. The median maximum drawdown was 2.87%. One case experienced no drawdown from that date, never dropped below it again over the next year. And the worst case scenario was 1960. In the first 120 days, it experienced a drawdown of 8.12%, but went on to post a 20% plus gain in the first year. Once again, we know where the S&P 500 was when we had this signal like this in 2019. It was at 2704. The average and median drawdowns relatively muted down to 2615 and 2626. Worst case scenario, which would be this scenario here, would take us to 2485. What does that look like on a 2019 chart? Fairly muted, with the median and average decline in the Bollinger Band cases. Once again, for the most part, aligns with what could be somewhat of a right shoulder formation over here, coming down to these two gray lines. And the worst case scenario was the 8% drop, which is this cyan line here, at 2485 hypothetically in 2019. And we should keep in mind, the median and average numbers here are based on 11 cases. The worst case line here is based on one of those 11 cases, which speaks to probabilities. And this is what our 11 consecutive trading days above the 200-day moving average case looked like. The green and the blue lines are the median and average cases based on 11 total cases. The orange line is the worst of the 11 cases. It's obviously based on one case. Out of the 25 breadth thrust cases, there were 20 of them that we're interested in tracking. The average and the median here in black. And one of those 20 cases produced the red line here. How about the 9 consecutive trading day closes above the 200-day after a 15 to 30% drop? The average and the median maximum drawdown, they were so muted we didn't even put them on the graph. They'll be up here somewhere. The maximum case is shown in pink here, which would also align somewhat with the possibility of a right shoulder forming. So these are all of the cases that we've covered. Out of all the different scenarios that we studied, it's 52 separate cases. The orange line is one of those 52 cases. The red line is one of those 52 cases. And the cyan line is one of those 52 cases, which is less than 6% of the total cases studied. So from an odds perspective, most of the drawdowns were more muted than these three cases here. But these cases remind us that it's still within the realm of possibility that we may get a fairly significant drawdown even under a longer-term bullish scenario. And when we factor in a trend strength reading of 56 as of the close on Thursday, March 7th, and the scale is from 0 to 100, and considering we've seen almost no retracement relative to this V, it wouldn't be shocking to see the market drop 9.57% from the March 7th close to reach the worst case scion line down here. Not a prediction, but this helps us with risk management. A 9.57% drawdown sounds terrible, but we have to keep in mind that would assume that you're 100% invested in the S&P 500. So for illustrative purposes, if you're 50% in the S&P 500 and 50% in cash, then this drawdown would drop down to a much more manageable and sleep at night 4.78%. Moral of that story is our allocation mix accounts for what is still a wide range of outcomes. History tells us we could still see a fairly significant drawdown, and history also tells us the average and median cases, for the most part, experienced very, very muted drawdowns, telling us wouldn't be shocking to see the market stay in this region here and then eventually go on to make higher highs. And you'll notice in this case here, the median drawdown would be 27.50. We closed at 27.42 on March 7th. The average drawdown would be 27.24, which is the green line and the blue line. Thus, using this historical analogy or similar cases from a historical perspective, it's possible we won't see much more of a drawdown at all from where we are today. That's all to be determined. Given it's still within the realm of possibility, the S&P 500 could fall back to 2603, 2520, 2485. And mind you, these are still bullish cases. We're very, very comfortable with our current asset mix, which is still in line with the facts that we have in hand today. We can easily migrate to a more growth-oriented posture. And as we said way back on January 25th, if we jump the gun here in this historical case and threw all caution to the wind when the S&P 500 closed a few days above the orange 200-day moving average here, it would have been much, much more difficult to navigate through the roughly 35% loss that occurred between point A and point B. Patient, prudent, measured, and data-dependent would have been extremely helpful on October 26, 1973, when the S&P 500 had closed above the 200-day moving average for somewhere in the neighborhood of 3 weeks here. What happened next? From this area here to point B was a 44% loss. Patient, prudent, measured, and data-dependent would have been very, very helpful here when price was rejected at the 200-day moving average in May of 2008. From this point here, the S&P 500 lost an additional 53%. All of the work that we're doing is just trying to help us understand a reasonable and wide range of outcomes. We're not forecasting anything bullish, nor forecasting anything bearish. But you have to keep in mind, when we say the S&P 500 could fall to 2603, 2520, 2485, that's in the context of bullish cases. We've been weeding out the less favorable cases. Why does it still make sense with a score like this and a market that's floating just above and below a 200-day moving average to continue with our patient, prudent, measured, and data-dependent approach? Because if you think these drawdowns make your stomach hurt, as we covered back in February, if we assume this was a major top and we experienced declines similar to 1987, 62, 2000, 2007, 29, 37, 46, 61, 68, 73, and 80, from where the S&P 500 was trading in February of this year, February 7th, the average additional decline in these 11 cases here would be 40%. And one of the ways that your allocation mix can mute this type of potential drawdown is the fact that it's within the realm of possibility that the defensive assets in your portfolio can go up on days when the market is falling. One example, Thursday's session, the S&P 500 was down 0.81%. To help offset that, bonds, TLT, up 0.76%, and IEF up roughly 0.4%. So how does this analysis help us? Going forward, any type of drawdown or give back that comes into this area here from a historical perspective shouldn't be surprising nor shocking. The further we move below the orange line, the more concerning it becomes from a probability perspective, and it starts to increase the probability of some of these very unfavorable cases rearing their ugly head in the present day. With our current allocation, it's reasonable to deal with very bullish outcomes, and we're still in a good position to deal with much worse than expected outcomes. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.